Hi, everyone. This is Tony D'Amico, founder and managing partner of Fidato Wealth. Thanks for joining me today for this video. The last several presidential elections, we've done research around, how does a presidential election affect the stock markets and market performance? So I think you're going to find this very helpful. We're recording this on February 8th, 2024. So let's jump in. Okay, we obviously don't know for sure who is going to be squaring off. That hasn't been finalized yet, but signs are pointing to it being Joe Biden versus Donald Trump again. We shall see. Let's jump into the material, but first, our disclosures on the screen there for you to view in full if you'd like. The one thing that I want to focus on is that if you're not a client of Fidato Wealth, we obviously don't know anything about your specific financial circumstances, your life goals, or how you're positioned financially. So we can't obviously advise you because we don't know your particular situation. So please don't take anything, as we're saying here, as advice that you should implement. Having said that, I feel like we're going to be reviewing some great information that will be helpful for everyone in understanding the markets when we are in a presidential election year and even following a presidential election. Okay, so here's what history tells us about US presidential elections and the market. So you can see here, there are obviously this showing you both Republican and Democratic presidents. And you can see here over time, right, the S&P 500 from 1926 through 2022 has overall went up. Okay, besides there being two specific points, right, where there was some severe decline, the Great Depression and the Great Recession, right? Those were two very difficult times. But I also want to take a minute to talk about the 2016 election, because that was a time where I feel like the research we put out was very helpful and helping people make the best decision for them and their families. Again, the 2016 election, and we had financial experts that were predicting a decline in the market if Trump won. Some went even further with their predictions. Actually, Simon Johnson of MarketWatch wrote, the election of Donald Trump would likely cause the stock market to crash and plunge the world into recession. And in an interview with Neil Cavuto, billionaire Mark Cuban said the following: in the event Donald wins, I'll have no doubt in my mind the market tanks. So that's what he said. He even went as far as to say is, I'll put a hedge on his investments to protect him if he wins. Now, those hedges are very costly to execute. So if he did do that, boy, he would have lost money, right? We don't know if he actually did that or not. And really, to the surprise of the pundits, the opposite occurred. The markets went up substantially under Trump. Markets have also went up substantially under Biden. So what are the takeaways here? There's no real correlation between the political party in the White House and stock market returns. No matter how much you fear the policies of the other party, companies generally still find a way to make profits and produce positive market returns. So the stock market, again, was consistently and predictably positive from 1926 through 2022, with a few only exceptions, most notably the Great Depression, the Great Recession, and actually the tech bubble burst as well. So your behavior, not the result of the election, is more likely to impact how your portfolio performs. All right. So this is Vanguard Research going back to 1853 through 2015, and it shows you the returns for a Democrat president and Republican president are identical. Okay, so very helpful research. They're identical. And again, what Vanguard said is the returns of the stock market under Democratic and Republican administrations are virtually indistinguishable. But they also go on to note that there's other factors that have a much bigger impact, such as the quality of the portfolio, your diversification, the asset classes you're invested in, and most importantly, your investment behavior through these times, right? I also looked at partisan control in market returns and refreshed this data as well. So there's 8 possible combinations of partisan control between who controls the presidency, who controls the House, and who controls the Senate. Now, 6 are shown because one combination has never occurred and the other occurrence only happened twice. Therefore, it's not statistically significant. And again, what is this telling us? Politicians have far less control over the markets than most people would like to believe. Really, most of the performance in the stock market under any administration depends upon where we are at in the economic cycle when they take office, right? The economic cycle, or you can call it the business cycle, is expansion, which leads to a peak, which leads to contraction and recession down to what's called the trough, the bottom, and then it repeats itself. Expansion, peak, recession. That is the normal business cycle. And again, returns are really dependent upon where they come in that cycle. So regardless of who wins the election, it's important to keep politics out of your portfolio, out of your financial planning. Like, listen, money decisions are already filled with emotions and blind spots. Bringing politics into the equation, I've never seen it work for anyone. I've never seen someone that brought politics in, because what are we telling you here? We use an evidence-based approach to investing where we rely on statistical evidence. So that's very important for you to understand, whether you're a client or a prospective client, right? We follow the evidence. And we do that because my goal is to provide the very best portfolios, not only to our clients, but to be honest with you guys, also me. I invest in the same funds that we use for our clients. So I want the very best possible return with the least amount of risk that's possible in our globally diversified strategy. Again, relying upon the evidence and the data and eliminating emotion. Okay, next slide here. Let's take a look at returns following presidential elections. So you can see that after 12 months, the returns are indistinguishable between Republican president and a Democrat president. So even after the election, we have that. Now, over a 4-year period, there are differences in returns. I would again contend that is more due to where we're at in the economic cycle. And this research was done by Goldman Sachs, and I really value their research and what we're able to access through them. So, and it says here, since 1976, the S&P 500 has offered approximately 10% in returns 12 months following the presidential election, regardless of which party won the election. So the other great part about the United States of America is the checks and balances that we have in place. We have the presidency, we have the House, we have the Senate. And so what we know, this was research by Wall Street Journal, they looked at change in House seats by the president's party during the midterm elections. And what we see going back to 1970, in all but 2 cases, whoever was controlling the presidency, whatever party was controlling the presidency, lost seats in the House, therefore promoting, again, checks and balances where there isn't one person, right, that is driving everything in the country. There are these checks and balances. The other thing that I want to touch on is not to do with elections, but something else that's a very important current topic. So what I want to review is why it's important to be globally diversified and why it's important to have some bonds, right? Depending upon your appetite for risk. So let's look at from 2000 to 2010. This light blue line is the S&P 500, right? We had September 11th. We had the credit crisis 08-09. And if you were a patient investor in the S&P 500 for that 10-year period, your reward would have been negative 0.95% as an annualized rate of return. So you would have lost nearly 1%. Now, thankfully, bonds, and specifically investment-grade bonds and stocks, are not correlated, right? So 97% of the time, they're going to move in a random direction, okay? Now, unfortunately, the last couple of years, both bonds and stocks moved in the same direction, which was very challenging for folks. Thankfully, that doesn't happen that often, okay? But it has recently. But let's focus on the decade of 2000 to 2010. Look at what the bond market did during that period of time. It grew by 6.33%. You guys probably know if you earn 7% net on your money, it doubles every 10 years. So bonds did fantastic during this time period. So important to always have a fully diversified portfolio that's not relying on timing, right? Because it is impossible to know when is large cap going to start to come back, right? Large cap, why is this important? The S&P 500 over the past 12 months is up. I think it's like 24%, right about there. So it's up a lot. But now this dark blue line is going to show you the importance of having not just large cap stocks, but also, so this is showing you 70% in US stocks, but a combination of large stocks, mid-sized stocks, small-sized stocks, and having 30% in non-US funds, such as international and emerging markets. So look, if you were globally diversified in a stock portfolio, your return would have been 7.44%. Obviously, this is an index, so you can't invest in that index pretty well directly, or you may have management fees associated with that. But those asset classes returned 7.44%. Obviously, much better than negative 0.95%. So our philosophy, again, is evidence-based approach. We know that stocks do better than bonds over the long run, right? Equities or stocks is where you create wealth. That's the evidence going back to 1926. Also, the size of the company matters. Small company stocks outpace large company stocks over the long run. We know the price that you pay for a stock matters. The better the price compared to the book value, the better the performance. So we're talking about having a tilt towards value stocks where you're getting it at a favorable price compared to the book value of the company. The other factor, companies that are highly profitable perform better than companies that are not highly profitable. So that's important as well. And we already talked about the importance of having some international exposure. And so we've looked at that research and we've determined what is the minimum amount of international and emerging markets that we need to gain the diversification benefits of that global diversification. So with that, we have a bias to US stocks, right? And we have what we feel is just enough to gain the benefit. So I've seen other portfolios that will have a lot more in international, right? We want to have the minimum that we need to. And in that international, we also include real estate, right? Which even further diversifies that. So real estate in our mind helps us protect us from having uncorrelated assets. So if US stocks are down, real estate and US stocks, they move in a random direction about 50% of the time. So that's very important. So what are we saying? There is evidence, there is statistical significance in how the portfolios are constructed, and the portfolios are not constructed for one presidential cycle, one economic cycle. They're built for the long term. So very important to know. I wish I had a crystal ball and knew when to pivot from US large cap to international. But if I knew how to do that, I probably would just be managing my own money because I would be able to double it and triple it on a regular occurrence. Okay. So another current topic that I think is important. A lot of people were very fearful of a recession last year. And there were some times where things looked kind of iffy, right? But then the economic data did improve, okay? Which kind of goes to tell you, again, you really have to understand your investment philosophy if you're managing your own assets, or if you work with someone, do you understand how they're managing your money? I think that's really important because recessions do happen. And while recessions are painful, expansions are way more powerful. So you can see here, there are some blips here of recessions, these reddish color here at the bottom. So that's important to look at there. But look at these blue spikes here, right? Expansions have been way more powerful. The average expansion lasts 67 months. The average recession lasts 11 months, okay? So that's pretty amazing. You can look at, and this is interesting, obviously GDP is up during expansions and down during recessions, but look at the S&P 500 returns. They're much higher during expansion periods, but they're still up in these recession periods. S&P is up 3%. Why is that? This is important to know. If you want peace of mind, this is really important. The stock market is a forward-looking indicator. So what that means is the stock market, when it closes that day, it's not measuring the profitability of those companies that particular day or that particular quarter. It's assuming what their profitability will be moving forward based upon economic conditions, based upon what that company is doing to improve their product or service or improve profitability. So it is a forward-looking indicator. So I've seen this happen, right? Because I've been through these cycles. I've seen this happen where the stock market starts going up while we're squarely in a recession. And that is because, again, the markets are forward-looking. So at some point, the markets are saying, wow, these companies are going to return to profitability. Prices go up while we're in a recession. That is why the S&P 500 goes up during a recession. All right, so what are some other distractions? Gold or precious metals? Yes, gold has done well recently. Why don't we invest in precious metals? There is no statistical significance that can be reliably traded on, and we're not in the guessing business. We have a fiduciary duty to our clients, and we want to seek out the highest possible return with the least amount of risk, and that requires prudent, disciplined investing. We always tell our clients we have our plan A and there is no plan B. We follow something that has a long-term track record of statistical evidence. Bitcoin, there are some pretty famous people or popular people that are talking about Bitcoin. Jamie Dimon is one of them. Some of the things that people are saying about Bitcoin are, not favorable. Could this end up being a great investment? Possibly, but we are investors, not gamblers. So that's important to note. Now, having said that, do we have access to private equity, private real estate investments for very wealthy clients? You bet. But the base of every plan is having a globally diversified portfolio. And that's what we're talking about. Another thing that we avoid is the most popular investment, right? There's always some sort of fad that's coming along. We stay clear. Market timing, right? When markets are doing well, people become overconfident and think that they can move from asset class to asset class or pick a particular stock. And the way that I tell folks is that the institutional managers that we use, they have campuses of people globally that are watching the prices on all the stocks and bonds that they own in their fund, which you benefit from as being a shareholder, right? They're looking at these investments daily. Campuses of people globally, monitoring things, making changes when there's a reason to. No one person can have that much resources or expertise or specialization. And I think that's important to note. Might somebody get it right? They might, but that is not reliable. That's not predictable. All right, really what I want to finish with is markets have rewarded discipline, and the news and financial commentary, I think it's important to note, good news does not sell advertising for media companies. It doesn't. Fear and greed is what sells advertising, okay? When we look here, look at the long term, the overall stock market, the world index of the stock market has gone up. And we've heard all sorts of news and financial commentary, which quite frankly is garbage. And again, you have to have that strong investment philosophy, that understanding. I would also say the important thing is this is why we don't just manage investments for clients. We don't want to just manage investments without having a financial plan and a wealth plan. Your investment strategy should be determined not just by your risk profile score, but your financial plan, and understand how you are invested is driving the probability of success in your financial plan. That is important. That anchors your investment strategy. Okay. So, there's a lot of things we hear from friends, neighbors, family, the news. Someone has quote unquote insight that, they're thinking there's going to be a fast, easy return. So these are things, again, that might somebody be right? Yes, but I haven't seen success stories there. Growing wealth has no shortcuts. Success requires a solid investment approach and a long-term perspective. And, as evidence, look at some of the things on this chart, right? We had an oil embargo. We had really high inflation at 13.5%. We had gold hitting a record high. Business Week came out and said the death of equities, like they were predicting stocks to be down for a long time. And look at what the stock market did. It went up significantly. We had Black Monday. We had a savings and loan crisis. We had the Russian financial crisis, the Y2K scare. Everything was going to crash. Okay, we had 9/11. We had the subprime mortgage crisis. We had the US real estate prices hit rock bottom. We had COVID-19. We had a global pandemic. And what does this show? The markets keep on going, right? And I think it's important to really think about all of the things that America, the United States, has had to deal with. All of these items, and maybe all of these items weren't addressed perfectly, but they were addressed to some extent. And I think that is, quite frankly, the thing that I notice, which concerns me the most, is that, yes, America has some challenges right now. Our debt is at record levels. The deficit, the lack of collaboration between political parties, right? Those are real things that are economic things, right? And that's what I focus on. We don't focus on politics whatsoever. We focus on the economic evidence. But here's the thing. Capitalism has prevailed. America's track record has prevailed. And the way that I view it is that there's one thing to do. There's one thing that a family can do or an individual can do is to be an owner. You have to be an owner in companies to benefit from their success. That is the way, in my opinion, to protect yourself, is to be an owner in companies, also own bonds through the funds that you're invested in. That is what I think insulates us from different forces. And I think the thing is again, look at the track record of not just the US market, but the world capital markets. We are all dependent upon a functioning capitalistic society where goods and services are provided that add value to people, individuals, businesses, etc. And there is an exchange, right, of money for that good or service. That has been the story of America. And by investing in a portfolio, you are counting on capitalism to continue. You are counting on the hope that America will continue on its path that it has been. So I think that is very important. I really wish there was a little bit more hope and optimism. Again, for us and investing and wealth planning, we are going to stick to the evidence. And we think the future is actually bright. While all these challenges, we believe the future is bright and things will be solved and things are going to keep moving. Will there be challenges along the way? You bet. All right. So again, my advice to you is focus on what matters. Is your portfolio diversified? Are you invested in asset classes that have an optimal long-term risk-reward relationship? Focus on the long term. The more you check your investments and the news, I believe the less chance you have for long-term success. Meet with your advisor. Again, if you're not a client of Fidato Wealth and you're watching this video, it's very important for you to understand the investment philosophy, okay? Sometimes when we review client portfolios, we will see, okay, there's an investment philosophy. But I will tell you, often there is no rhyme or reason or no evidence to the allocation. And again, we are regularly reviewing portfolios, reviewing the fund managers, looking at peers, looking at data. And again, I want the best for our clients, but I want the best for me because my nest egg is invested as well in this strategy. And because I understand it, I am completely comfortable. You just have to do what is the right thing to do and continue to monitor in the investments. It's also important to take advantage of any market fluctuations, such as rebalancing, making contributions. 401k contribution limits went up a little bit in 2024. So If you haven't upped that at your employer, you're going to want to. Roth conversions. We love doing Roth conversions when the market drops because it's typically much better because you can convert more shares. We're typically converting shares when we do this. Sometimes it's cash based upon the client circumstances, but it's important. We have a playbook for when the markets are up and people are getting overconfident. And we also have a playbook for when the markets are down and there's more fear. And that playbook, again, is evidence-based. And really, the question is, are you taking advantage of all opportunities and the ones that really matter? So again, my name is Tony D'Amico. Thank you for watching this video. I hope you found it helpful. If you did, please like it on YouTube. That would be great. If you're not a client and would like a complimentary consultation, you could visit our website, www.fidatowealth.com, and you can schedule a consultation right on our website. Thank you and have a great day.